two different trading styles, different offshoots, but I do want to talk about what these styles are all about, the pros, cons, and the key differences to breakout versus dip buy trading. I'm going to talk a lot about my experiences over the past couple of years, pretty much trying both of these things out, more so recently the breakout style. I actually originally got into trading breakouts when I started trading momentum penny stocks for day trades back in the day. Then I shifted towards swing trading, and that was much more of a dip buy approach. And then I switched towards options and losing lots of money dip buying options with time expirations. And then I've really moved myself around over the years. That's for sure. Done a lot, not everything, but I think I have some good insights to share and some ways to prevent losing as much money as I did and maybe maximizing some more of the upside. Let's dive into dip buy trading first. And I want to talk about this because it's more of a trend reversal trading strategy, if you will. And what I mean by that is you are trying to ultimately time a bounce. It could be a short, it could be a long, and if you're shorting, you would be looking for a downtrend ideally, and you're looking for a pullback, which would be more of a bounce up towards that downtrend in a reversal, and playing the reversal back down to ideally a lower low, and opposite on a dip buy and a long, like you've got a bigger picture trend to the upside. You can think of the S&P 500 as an example over the years. When the market dips, 10, 20, 30%, decently, and it's a decent opportunity. Generally speaking, if you buy that dip a couple years later, decade later, 2 decades later, you're going to be pretty happy with yourself. And that's what history would tell you. Of course, it doesn't have to repeat. Nothing is guaranteed, but history would tell you that that's a good strategy. And that's what you'll find with a lot of dip buyers on a lot of stocks and blue chips, dividend stocks, S&P, Dow, NASDAQ, etc. But in the trading sense, you can trade anything. Crypto, stocks, Forex, whatever you want to do. Futures, doesn't matter. But one of the biggest pieces to a dip buy strategy is the trend reversal. Now, yes, you could say you are playing with the bigger picture trend, fair, but you may not be doing that, A. And B, it generally is a slower strategy. When I say that, I mean that you are not playing a momentum break up or down over a very key support or resistance. You are playing ideally something that is either going to bounce quickly or slowly round itself on a rejection or a bounce off of a level. And those can take time. And looking back and tracking and journaling or back testing, we don't realize how much time it does take. But when you are sitting in the trade, I have found that it can be pretty slow and painful at times. And there's a lot of opportunities for your emotions to say double down, cut it, screw this one, let's go to this one. Just jump around versus just let one of them play out. If you're dip buying a lower wick or an upper wick, I guess if you're shorting an upper wick that had a quick move, the problem with those is that they can be quick, but they can also be a lot more risky and more volatile. So I have always stayed away from those, although it was something that I definitely had done and had some wins and had plenty of losses as well in the past. But when it comes down to the core, you are looking at a big picture for trend direction. You're using things like trend lines, maybe moving averages, maybe volume. You're using a lot of these different things to kind of gauge if you are getting a good dip and is this a good risk reward for a reversal to continue to develop here or start here and potentially go back in the direction of the bigger picture trend. Now, breakout trading is a lot different. But at the same time, they have their similarities. You're looking for more so support and resistance breaks, whether it's trends, breaking of a downtrend, breaking of an uptrend. Personally, I have played much more of a horizontal support or resistance break, up or down. Those tend to be a lot faster. And when I say a lot faster, I mean pretty quick if it's going to work or not. If it's not going to work, it's going to break it many times and then go up and come right back down pretty fast if it's a false break. Or it's going to break it and we're going to see momentum push through and it's going to push. And if the market's choppy, maybe it breaks and it slowly kind of chops higher or chops lower and then eventually it's your stop or your take profit. Those happen a lot less often than the first two scenarios, either a false breakout or a momentum push. So the reason why I have kind of fallen into that style lately is because from a trading perspective, I think that aligns a lot better with what I am trying to do with trading, right? It's get in, get out, move on. It's a skill that you're trying to develop and a strategy you're trying to build to get in, get out versus hang around for who knows how long. Of course, I'm still going to do that at times. Certain trades happen, things happen, but it happens less with breakouts and momentum. Now, I have essentially gotten myself to the point where I save all the dip buys for ETFs, for long-term investments that I will just dollar cost average into over time. And if I'm looking to go deeper into margin to like dip buy an ETF, like I'm looking for a deal. I'm looking for something that's pulling back that I can put my money in, get paid a dividend, sit back, let the S&P do what the S&P does type of deal. That's more of where my dip buy approach now comes into play versus my trading approach is much more like right now, it is what it is, period of time during the day that I look for stuff. Outside of that time, we move on. You also have to pay attention to the big picture trend direction because you're generally not going to be playing breakouts on things that have been trending down and breakdowns on things that have been trending up, generally speaking, because you are going against the grain of a bigger picture trend. And as the saying goes, right, the trend is your friend. Now, I think that's pretty important and has definitely allowed for me to kind of simplify things down. But just like anything else, that's not always the case because as the trend continues into more of a parabolic mode, eventually it's going to end. You just don't know when, and the chances of it continuing start to decrease the longer it goes on, right? So that's just kind of the nature of the market, the nature of how things work. And I think all of that can be factored in to a trading strategy, but not as easy as you may think. And one other difference here is that, well, maybe you're using moving averages for a dip buy approach. Here you could be using exponential moving averages, which are a little bit more tighter to price action. Not that you can't use EMAs in a dip buy strategy and moving averages in a breakout strategy, but generally speaking, I would like to use the exponential moving averages as once that break in momentum, this trade is now no longer a momentum trade, and I tend to get out once one of my exponential moving averages breaks, whereas the 50 SMA, for example, could be a good bounce spot for a stock that's trending up, pulling back to that 50 moving average, simple moving average, rounding itself, pushing higher. That could be a good kind of line in the sand, like, hey, it held the 50. That's a good sign. It's still strong. Maybe this has more legs for upside. So that's my experience trading both ways. You can certainly do both. I just find it very difficult to try to do both and determine which days are dip buy days, which days are breakout days, versus trade one of them and then know when to not trade it versus when to trade it is kind of the approach that I prefer. Everyone's different. I think that when you start adding in multiple things, trying to do multiple things, it adds to the subjective nature, which I think you need to try to eliminate as much as possible in your own strategy or style or trading or whatever, and need to be more objective. And so I'd rather be more objective than subjective. And when you start kind of blending and blurring the lines between these two different things, it gets a lot more complicated. So I encourage you to try both. See which one fits your style better, fits you better, and let me know what you think in the comments. One of the best ways to journal your trades would be TradeZella. That is not a sponsor of today's video, but I would mention it down below because when I have traded both ways, I have tracked via TradeZella, more specifically now with my breakout stuff, but there's a lot of things I uncover that I can tweak, that I can improve on when I start journaling and tracking my trades truly with a platform like TradeZella that essentially does all of the hard work for you. All you got to do is come back in and analyze it and be like, oh, wow, that's pretty cool. Make the adjustment and move on. Thanks so much for watching. Thumbs up, consider subscribing, and I'll see you guys in the next one. Peace.